Woosaw. You guys need to be chill as a freaking cucumber in this volatile market. That is why I'm throwing up this backdrop today, because the conversation we're having is based off a comment on my live stream when somebody asked me, are we going through basically a value reset? Are we going to see these large index funds, your S&P 500, start reverting back to their median price to earnings multiple? Nobody really knows, but I realize saying that statement is so broad and misunderstood amongst new investors that it would be really educational today to break down what a price to earnings multiple really means, how price to earnings work, and then we're going to look at the historical averages, guys, of all of these top weighted companies, because you are going to be insanely surprised by where the price to earnings were on a lot of these things like Apple, Microsoft, Facebook, Google, etc. over the last decade. And then we're also going to take a little bit of a look into some Google trend data along with some margin data, like people leveraging capital into the markets and what all of this means. Now, obviously, I'm not trying to predict the future here. This is just going to be an educational video. If it's something you appreciate, just do the channel a favor, folks. Hit the like button, because nobody actually knows when the market's going to crash. But I can guarantee you one thing, and that it is inevitable that the markets are going to drop at some point. They don't go up forever. Well, actually, they do go up forever. I mean, historically, over a 20-year period, they've always gone up, right? It's just a matter of riding the waves and understanding that things can cyclically go down in recessions. We're always going to have another black swan event. It's just an inevitability of being an investor in the market. But first and foremost, guys, we're looking at the S&P 500 price to earnings multiple, which in the past, anytime this multiple has gone parabolic, has been in the 2008 financial crisis, the dot-com bubble, and every single time, even going all the way back to the 1800s, it's always reverted back to this median of about 15. First of all, for newer investors, what does price to earnings even mean? Well, in very simple, refined terms, just presume that if you're buying a company today, let's say I put $100 in it, how long would it take me to double my money off what that company is capable of earning over time? So let's say Apple has a PE, and this is just random, it's not the real PE, but let's say Apple's trading at a PE of like 30. That means if their earnings don't go up or down, it would take you 30 years at their current earnings capability to get a full rate of return on your money. Now, this is all divided out by the earnings per share. Every quarter, every company will post what they call an EPS number, which is basically taking the total revenue they made or the total earnings after all the costs and, all of the expenses. How much did they actually retain? Divide that out by all of the shares outstanding. And that's why you're going to hear like a $2 earnings per share this quarter. If you take that and divide it by the current share price, one single share price, that's going to tell you how long it's going to take to get those earnings dripping in to equal one share price. Thus the price to earnings multiple. Now, what you have to understand looking at the PE chart here, guys, it fluctuates off many factors. If stocks go down, obviously the price to earnings are going to come down with stock prices going down, because obviously the earnings, if they remain the same, is going to take a lot less time at a cheaper stock price. However, if earnings go up over time and stocks stay flat, that can also bring down the average price to earnings. That's why this isn't a chart that always goes up or down. It kind of remains stagnant based off the current market's understanding of what they're willing to pay for stocks. And this is highly dependent on the future and us predicting the future. And I hope that kind of makes sense, because right now the S&P 500 sits at a PE of 25, largely driven by two things bringing this down. Again, earnings have gone up. Apple had gangbuster earnings. Microsoft had gangbuster earnings, but their stock prices have dropped. So now we have earnings going up, stock prices coming down. Both of those bode well to see price to earnings drop, which is great for investors because now you can buy in at cheaper valuations. So before we look at these actual companies themselves to get a better base value of the past to where we're looking at today, I just want to point out the margin debt in the market. This is a real contributing factor to how much greed exists in the market. And we saw record high margin debt of people leveraging capital from their brokerage firms into stocks. And honestly, now that we've seen this massive correction amongst small caps that kind of really took off toward the mid to end of December, when we started seeing a slight pullback in the actual total margin that existed in the market, I think honestly, when we get the January numbers from FINRA, this is going to be astronomically small. I mean, I think we're going to see a 20-30% reduction, as a lot of people were getting margin called throughout this, right? So that's good for us as well, because that also means that there's a lot less risk and speculation in the market, and we're starting to dry up a lot of the speculators. So it's going to be neat to keep an eye on that data. But let's take a look here first and foremost, guys, with Apple. Now, Apple, the golden child of the entire markets. You always hear people say, oh, well, once upon a time, Apple had a PE of like 9 and 10 and 13. Yeah, about a decade ago, they did, when people were a little bit more hesitant on how fast their price to earnings could grow. But now that we kind of hit this pandemic period where everybody's just loading up on Apple products at home, that has really driven up their earnings, and that has pushed up the stock price, that has pushed up future expectations, and that has obviously driven up the price to earnings multiple, which exists down here, right? Now, the scary thing is a lot of people are now predicting that now that we're on the other side of the pandemic, people are less inclined to buy new laptops, less inclined to be buying new phones. We all kind of upgraded our phones. And if we start seeing a slowing period within the earnings multiples, that's not good, guys. That means that we're paying way too much for the company at a PE of 28. And that means if we start missing earnings growth, that the stock's going to start coming down and a lot of people aren't going to be happy. And this is where a lot of the fear comes into 2022. As interest rates go up, people have less money to spend. Companies have less money to borrow. Not that it matters for a company like Apple, but it does matter from a customer standpoint because most people aren't buying their products with cash, I would imagine. So anyways, let's take a look at Microsoft, for example, another favorite company of mine. This company actually isn't sitting at its all-time historical PE ratio. Actually, its historical high PE was back in 2017 when it was trading for about 46 PE ratio, at around a 46, which is insane, right? But what's crazy is the PE has come down, yet the stock price has gone up. So we can see how the actual earnings affect these two different charts. And right now, a lot of people are like, oh, Microsoft's screamingly expensive and all this stuff. But historically, from a price to earnings multiple, it's actually trading down to a 5-year, well, not the 5-year low, because the 5-year low is about 22. But you're always kind of paying an overvaluation for this company because the earnings continue to go up over time. And like I said, guys, if this chart on earnings here, if you just take a look at this, if this ever slows down, that's when you're going to see a heavy correction in the stock price. And that's why people are always a little skeptical of how long can this last when we're looking at Microsoft, a company that didn't have any real EPS growth for almost a decade. They had nominal income. And that's what led to these lower price to earnings multiples, right? When, Microsoft was trading at the PE of 10 to 12, like Apple. So let's take a look at some of my favorite companies, because this is where we start seeing value deals. And this is where I keep saying I like Google, I like Facebook, and here's why. Taking a look at Facebook, guys, really consistent EPS growth over time, but we can see back 10 years ago in 2015, 2016 timeframe, it had a multiple of 90 on it. You know how insane that is? A multiple of 90. Yet we come into the future here, guys, and now all of a sudden the multiple's actually at historical lows around 21. So this is where we can kind of get a little bit more of a bull sense on the company because the EPS number is still consistently going up. So this is where we can start getting into value plays in large caps. What about Google? Google McDougal. And take a look at this one. In 2018, this thing hit a historical high PE of 58, or 2017. Earnings kind of kept up, and all of a sudden, guys, now the PE ratio says at 24, which is a historical low for this company. Actually, these are lows we haven't seen since something like 2013. So this is where you can start getting bullish if you think these companies are going to continue to grow in the future, because we're not actually paying the historical highs in the valuations, which is kind of neat. Now let's talk about Tesla, for example. Tesla is one that's really intriguing to me because actually, I'm going to put this next to Amazon. I think Amazon and Tesla are going to be two good counterparty companies to compare to, because historically, I could never buy Amazon because the price to earnings multiple was in the whopping 500s to 1000s. And this was only 7 years back in 2015, right? And we can see anytime a company doesn't post EPS numbers, if they have no positive earnings, you can't actually run a price to earnings multiple. You can't run that metric. So that's why we see out of nowhere Amazon dropped down to no valuation metrics. The PE was 0 because there was no way to value it. But take a look at that, guys. Not even 7 years ago, Amazon trading for 720 PE and nobody would buy it. And today it's at a 54 PE. The stock's at record bounding highs. And, look at the EPS numbers. They've grown. Now, as we take a look at the last earnings, guys, there has been a little slowdown in people buying products. And we see that in the slowdown in the earnings per share here too, right? Well, maybe not. The earnings per share really only reflects all of the expenses after the fact. So you might want to look at the revenue numbers and make sure they're still growing, because some of these companies control their EPS numbers a little bit. But historically, this is a major low valuation for Amazon. So if you think Amazon's still going to continue to grow, might not grow at the EPS rate it did in the past, you're still getting a way better valuation than you were back then. Now, comparing that to Tesla, guys, it seems very reminiscent. Tesla's a company growing at like 50% EPS growth right now, which is kind of nuts to consider. But as we take a look, when Tesla started posting its first positive EPS days back in March of 2020, people started running valuation metrics, and we could see Tesla in the midst of 2020 hit a PE ratio of 1,102. Think about that. It would take you 1,000 years at that current price multiple to get all of your money back. insane, right? But that's because we know Tesla is going to be one of the fastest growing companies that currently exist in the US. And this is why if you believe Tesla is going to grow at a 50% clip year over year, every single year, you can drop the price to earnings like by 25, 50% a year. And that really catches up fast with the valuation you're overpaying for it today, right? So this is kind of how those metrics come into play. Maybe we'll look at two more real quick. What about JP Morgan? Now this one, probably a great buying opportunity. And I keep saying that, guys. Like, I love the banks for this reason. The banks are trading at the relative historical medians because back in the day, I mean, you go to 2014, there was a price to earnings of 12 on JP Morgan. Today, it's sitting at 9. So you could say you're actually getting a better discount today than you were 10 years ago. Even though the earnings have exploded, the charts rallied fairly nicely. This is like a really healthy looking chart. This is for those value investors that aren't looking for the wild instability of predicting future income. And this is where you want to have some of these companies in your portfolio because they stabilize things. They're very predictable. They're very safe, right? Like, let's take a look at NVIDIA. Here's another crazy growth metric one. This is the historical high pretty much for NVIDIA's price to earnings multiple. And I know there's going to be a lot of growth for this company, but you just kind of take a look at these metrics and they're all off the chart. You're overpaying for this company huge. The EPS number growth is huge. The stock price is huge. So this kind of gets a little bit scarier, right? Because I honestly think once we get through the logistics and the supply chain issues and NVIDIA can meet the market demand, I'm really curious to see how much of that comes into play at the current valuation because you're kind of paying for that right now. And that's a little scary. I mean, it's hard to predict the future, guys. But putting all these price to earnings aside and kind of using these valuation metrics, let's talk about some other metrics like Google Trends. This kind of shows you, and a lot of people have been using this lately to predict future data. And I'm going to show you how incorrect this data can truly be because this is just people going on Google searching up iPhone. And a lot of people going into this earnings said, oh, compared to last Christmas, this is the lowest volume anyone's ever seen on Google for people searching up iPhone. And if you made that prediction, you were just horribly wrong. And Apple had gangbuster iPhone sales, record EPS numbers, and then all of a sudden we've seen a bit of a downtrend here. A lot of people might not use Google to look up data, guys. A lot of people might not go on Google to look up iPhone. Like, not everyone's Googling that, but they might go into the Apple store and still buy an iPhone. So you kind of got to pay attention to some of these trends because they're very interesting. And a lot of people have been looking at auto loans lately and saying, hey guys, we might be heading into some scary territory because a lot of people aren't buying autos. And historically over time, guys, autos have actually come down in total volume sales globally. I mean, considering in 2020, we've seen this kind of pullback here, and that was kind of like, look at the midst of 2020, because that was the last peak we had in auto loans, and now it's pulled back, and so is the kind of the historical data between 2020 and 2021. So it's hard to actually state that these are defining indicators of us heading into bear markets. Nobody actually knows because I would state that we are probably one of the greatest job markets in history. We're in one of the easiest markets to go out, get a job anywhere, ask for a raise. This isn't like the recessions we've seen in the past. People aren't losing jobs in droves like they were in March 2020. We have this big problem with a lot of demand for jobs and not enough people going and getting those jobs. So that means there's a lot of liquidity still in the market, which kind of makes me bullish that, we're not going to be heading into some crazy recession bear territory. Recessions require people to lose liquidity in the market. I think there's more liquidity than ever, even if the Fed starts pulling it out of the market. Now, this has been a very broad topic conversation about price to earnings, and you have to look at these multiples saying, hey, if Tesla's trading at a PE of 300, but I think in 5 years, they're going to 5 or 10x their earnings per share. That means you're going to be paying a price to earnings multiple of somewhere between, say, 20 and 30 for that company, which honestly would be much more fair value. And I think a lot of people have a hard time kind of, putting that in their head, because if you looked at Amazon 7 years ago and you didn't believe in their business, you're like, why are they getting into shipping? We already have FedEx and UPS. Why are they doing their own logistics and warehousing? That doesn't make sense. They could third party that. They'd save a lot more money. But really, they saw the potential of the revenue and earnings they could make off of that. They dumped a lot of money into it, so they couldn't show really any bottom line earnings. And that led to EPS earnings multiples to be astronomical, if none at all. And look at how that worked out for them. So you have to kind of compare that to Tesla or other companies like NVIDIA that are incredibly fast growing. And you have to really search in your soul and ask yourself this deep question. Do I think this company has the capability of being astronomically huge in the future? Is it going to be solving problems for society in market cap capabilities that are larger than we've seen in the past? And if that is yes, and you believe it, and you can run a little bit of math and you believe those prices, when these stocks dip, guys, that is your opportunity to start cost averaging in. Again, stocks are always going to dip. It's not a time to get afraid. It's a time to be diligent, cost average into those great companies, and always make sure you have an emergency fund. But on that note, I pass the question off to you. This has been a very educational video. Stay cool, stay awesome, and I look forward to catching you in the next one.